Just a quick reminder, I will make some forward-looking statements during the presentation today. Also, just please note that all dollar figures in the presentation are in US dollars. So for those of you who are not familiar with the company, we are a producing gold company. We operate our namesake mine. It's called the Asanko Gold Mine. It's located in Ghana, West Africa. We built this mine back in 2016, so it's been in commercial production now for over 3 years. Last year, we produced about 228,000 ounces of gold from the mine at an all-in sustaining cost of around $1,070 an ounce. Last year, the company entered into a transaction whereby we actually sold half of the mine to Gold Fields, as I'm sure you know, of Gold Fields of South Africa, forming a 50-50 joint venture for the mine with Asanko as the operator. That allowed Asanko to, as you'll see in a moment, clean up our balance sheet and become debt-free. Just looking a bit at our corporate information, Gold Fields are not only our joint venture partner on the asset level, they are also a strategic investor in the company, owning just under 10% of the equity. We do have a couple of major shareholders, some of them here in New York. We trade both on the New York Stock Exchange and the Toronto Stock Exchange under the ticker AKG. And I think as I walked into this room, our market cap was around $220 million US. Importantly, let's look at our balance sheet. We do look at the balance sheet here on the right-hand side of this slide in two ways. We look at our corporate balance sheet. Right now, we're sitting with about $15 million in cash at the corporate level. We do have one final payment due from Gold Fields with respect to the transaction I mentioned. That's due on December 31st of this year. That will bolster the corporate treasury up to $25 million. We don't burn much cash at the corporate level. We are paid a management fee of $6 million a year to operate the mine. That covers our corporate overhead costs, etc. So we have a fairly stable cash balance at the corporate level at this stage. And then on the second half of the equation, at the joint venture level, the balance sheet at the JV, we do have, we're sitting on right now about $46.5 million in cash and bullion at the joint venture level in Ghana. There's no debt in the company or in the joint venture at this stage. Our intention, certainly when you see our cash flow projections here for the fourth quarter and into 2020 as we start to wind down our capital programs, we are going to generate quite a bit of cash flow, particularly in this macro environment. We expect that we're going to start using that treasury from the joint venture to bring up to distribute to our partners and ultimately to return some of that to our shareholders. Just looking at the joint venture from an operations perspective, you can see here the top right graph is mill feed, sorry, that's gold ounces produced, pardon me, on an annual basis, going back to 2016 when we brought the mine into commercial production. We now are producing, as I said, about 228,000 ounces last year. Our guidance for 2019 is to produce between 225 and 245,000 ounces. We're well on track to achieve that. We did just put out our Q3 production results this morning, if anyone you happen to see it. It was another good quarter with over 62,000 ounces produced. I think that's our fifth consecutive quarter of over 60,000 ounces of production at the Asanko Gold Mine. That puts us around 185,000 ounces year to date, well on track to hit perhaps even the upper end or exceed that production guidance. From a cost perspective, you can see our costs here have been averaging year to date about $100 an ounce more than our guidance of $1,040 to $1,060. That's on an all-in sustaining cost basis. What's really driving that is a major capital expenditure program. It's a stripping program on one of our main pits called Nkran. We've been at that now for a period of 18 months, and we're pleased to say that at the end of Q3, we wound that down. So we do, although we capitalize that stripping, in accordance with World Gold Council standards, we do bring that cost on a quarterly basis back through the all-in sustaining costs. So what you see here is maybe perhaps a bit of an artificially high cost for the first 3 quarters of the year. And what's subsequently coming in Q4 is perhaps even an artificially low all-in sustaining cost, where our costs will drop down, in fact, below $800 an ounce in Q4. So we're quite comfortable. We're going to achieve very close to our guidance there in an all-in sustaining cost basis for the year, as that pushback is now complete. And I believe that sets us up very well to be a free cash flow generator here in this fourth quarter and into 2020. You can see the bottom graph there, what you're looking at on the joint venture basis. The blue bars is our cash flow from operations quarter over quarter for the last 3 quarters. More importantly, the gold line is free cash flow. So that's cash after reinvestment in things like capital stripping and exploration. When you look back to Q4 2018, we were investing all of the cash flow from operations, in fact, even more than all of it, back into the ground. We now turned that corner and we're coming out of this phase of major capital investment. In Q2, we generated positive cash flow. Q3, with the strong gold price, even though we continued our capital program, we expect that trend in the gold line to continue. And Q4 is certainly going to be a very good quarter for the company in terms of free cash flow. And I think that sets us up very well going into 2020 to capitalize on this strong macro environment. I won't spend too long on this slide, just to show you that we do have a series of open pits on a wonderful land package here in Ghana. It's one of the main gold belts called the Asanko Gold Belt. We expect that we're going to have an 8 to 10 year mine life when we produce our updated 43-101, which we expect in February. That'll produce about 250,000 ounces a year at an all-in sustaining cost of around $1,000 an ounce. So what you're seeing for 2019, you can expect to continue to see for the next 8 to 10 years, generating meaningful cash flow with very little further capital investments required. When I said an 8 to 10 year mine life, that'll be our reserve base at the end of the year. That's based on what we have and what we know right now. I do think there's tremendous exploration potential, and if we are going to spend capital on anything, it will be on exploration. We committed an $8 million expenditure in 2019 that included about 15,000 meters of drilling. We expect to continue that program into 2020 with a $10 million budget for the year. And really what we're trying to do, you're looking at our concession map here again, what we're trying to do is a two-pronged approach to exploration. This is, again, a highly prolific belt, largely underexplored. Most of the gold on these concessions that we've found, the main deposits, occurs in shear corridors that you can see colored here in orange on the right-hand side of that graph. There are 4 main shear corridors that cross our property. We have found multi-million ounce deposits on this property already. We think there's a good potential to find more. But our initial focus, you can see those circles on the graph there, is going to be in close proximity to the processing plant. So that outer circle is a 6-mile radius or a 10-kilometer radius around the existing processing plant, which is right next to one of our main pits called Nkran. Our idea is to try and find some near-surface, high-grade resources that we can use to displace some of the feed that we expect to come from our Nkran pit. As the pit matures, it gets deeper. We've been mining there for 3 years now. By 2023, that'll be quite a deep pit. There's still another phase of ore coming out of that. But if we can find some lower cost at surface ounces to displace that and push that out in the mine life, we think it'll improve our margins over the next 3 to 5 years. So that's the one major prong of our approach. The second is obviously trying to find a longer term replacement from 2 of our main deposits, Esaase to the north and Nkran to the south. We think that there's a strong potential to do that. Our main target is called Fremenda, which is the very southern tip here. You can see a red star at the bottom of that graphic. There's some very good drill results that we've published for Fremenda that are available on our website. We expect to be drilling there in Q4 as well, and that's a longer term play. That's sort of adding to the back end of the mine life. So in a nutshell, whilst we have a 10-year mine plan that we expect to publish in February of next year, I think we'll be mining gold here for a very, very long time. Just to conclude, I do think we have started to gain some momentum. This strategy of focusing on cash flow generation is a new one for the company in conjunction with our joint venture partners. We've been communicating this to the market now for about a quarter and a half. You can see the blue line here on this graph on the bottom right. That's the AKG ticker on the New York Stock Exchange versus our peers and the gold price. Until recently, we were actually largely underperforming our peers as most of our cash flow was going back into the ground. I think now that we've turned that corner, we've set ourselves up very nicely for a strong 2020, and we're starting to outperform both the gold price and the GDXJ index. So what you can expect from this company going forward is more of the same, sprinkled in with some excellent exploration results, we hope, as we start to generate cash and ideally return some of that to our shareholders. I'm sorry, I don't think we have any time for questions, but thank you very much for your attention and your interest in Asanko Gold. I will be outside for a moment if anyone does want to ask any questions.